We did come to the same conclusion that we were probably going to see more deflationary forces at the end of all of this than inflationary forces. And I believe that we are in the early stages of seeing that.
It's been a long time since the last stagflation hit the United States, but many experts believe it could be making a comeback. The combination of sluggish economic growth and rising inflation can have a decidedly negative impact. Recently, in a weekly episode of ARK Invest, Cathie Wood and Nancy Lazar shared their thoughts on inflation, what they predict to be happening. In today's video, you will know about the economic growth, Fed, and what they're doing with their tightening and all that. So stay tuned till the end, and if you like the video, be sure to hit that like button. We can all witness more deflationary forces at the end of all this than inflationary forces. According to Cathie Wood, we're in the early stages of seeing this. Let's hear Nancy's point of view on this. But before diving into the video, do subscribe to my channel for more videos like this.
On the monetary side, the Federal Reserve is now raising interest rates. But actually, that's in a background of other central banks that have been raising rates already for over a year. We've counted over 180 central bank tightening moves. That is 180 interest rate increases over the past year. Not 180 central banks. There are many central banks that have actually raised rates several times, which is now what our Federal Reserve is just starting to do. But we are a global economy, and it is global rates that drive our economy. And it's not the level of rates. Here you see global short rates are still very, very low. Many of you would think 1.8%. Gee, that's much lower than mortgage rates. What's wrong with that? But they've increased. It's the change in interest rates when you go from 0.8% to 1.8. It's that increase that changes behavior, that negatively impacts economic activity. And it doesn't happen immediately. It takes time. It takes roughly a year to change behavior. And so we are right now in a period where the economy is already starting to slow. You've certainly seen that with a lot of company news where their earnings are starting to get hit and overall economic activity is starting to slow. And now the Fed is starting to raise rates. That's very different when they last had a tightening cycle, which was back in 2016. They were raising rates into an accelerating economy, and that gave them a couple of years of higher interest rates without really disrupting the markets or economic momentum. That's not the case today.
As you all know that the Fed has now started to raise the interest rates. I mean, it's hard to miss this when it's being the headline everywhere. But Nancy Lazar highlights that over 180 foreign central banks have already begun raising interest rates a year ago. According to her, global rates are weighing on the economy, and not on the level of rates. You can see in her charts that these global short rates are still low, much lower than mortgage rates. But it's the increase that's going from 0.8 to 1.8 which impacts the economy activities negatively. Nancy said, the overall economic growth is already starting to slow, and the Fed is starting to raise rates in between all this. She noted that the U.S. faced a similar tightening cycle situation back in 2015 and 16. But things are not the same now. Let's hear the reasons behind the slowing economy and what it states for the future.
The economy is already slowing. Why is it already slowing? Again, because global central banks have been tightening for a year. You also have higher bond yields. You have higher oil prices. All those things lead growth, and they are now in the prospect of slowing economic activity. And now the Fed is stepping in and raising rates. We would argue they're late. And these higher interest rates that they're putting in place risk creating financial strains. And in turn, we don't think the Fed is going to be able to raise rates as much as they currently suggest, say around 200 basis points, because between now and then, there's going to be clear signs that the economy is slowing, and even inflationary pressures are going to come down. So we will get another rate hike, most likely in February and probably even in August. We're not so sure how aggressive the Fed's going to be able to be in the fourth quarter, because we think by then it's going to be pretty clear both growth and inflation are slowing pretty significantly.
Yeah, Nancy, I'm also struck. The Fed is really focused on the U.S., but I think Europe is in a recession. China, some of the numbers coming out of China are shocking as well. That has an impact on the rest of Asia. So what they're facing is a recession, and their currencies are dropping. Their currencies are dropping relative to the dollar, which means their purchasing power is going down, but it also means that some of them are tightening more because their currencies are falling against the dollar. So it's a bit of a vicious cycle. And as Nancy says, I agree with you, Nancy, we are not alone. Many people are thinking about the US in isolation. We've already had 1/4 of negative GDP, which most people brushed aside, saying, "Oh, that's a fluke." And I think that was a real number, and we should not dismiss it.
The Fed is currently suggesting 200 basis points, but the situation now and then in 2016 are not the same case. There are going to be clear signs that the economy is slowing, and according to Nancy, the economic slowdown will force the Federal Reserve to stop raising interest rates later this year. Do you also agree with her? Let me know in the comments below. Still, we can witness another rate hike maybe in July or even in August. I have no idea how much aggressive rate the Fed is going to put ahead, but Nancy is pretty clear with her viewpoint that both inflation and growth is slowing down. Cathie Wood also commented that the Fed is focused on the US, while there's recession going on in Europe and China, and their purchasing power is dropping, with their currency dropping relative to the dollar. But it also means that some of them are tightening more because their currencies are falling against the dollar, so it's a bit of a vicious cycle. She also points out that we already have witnessed 1/4 of negative GDP, and she sees this as a real number which shouldn't be dismissed. With the Fed tightening the monetary policy and the global economic outlook turning bleaker, the U.S. economy will grow more susceptible to a downturn in the coming months. As you all know, the US dollar has been skyrocketing lately. So what does it imply for the economy? Let's get into the clip to know more about it.
Europe is already in a recession, to be sure. And don't forget, the strength in the dollar, to the extent their currencies are weaker, the strength in the dollar is actually another disinflationary event here for the United States. So that just further increases the odds that we can see inflation slow pretty quickly.
In the old days, in past cycles, many people thought that the dollar going up was the same as monetary tightening. It's a disinflationary force, and it's up 15% since the bottom, which is a huge increase for the dollar in such a short period of time, and really hurts emerging markets.
Absolutely. The dollar going up means that our imports from abroad are going to be cheaper and just makes it easier. And at the same time, the dollar going up further hurts corporate profits.
As the dollar strengthens, other currencies are weakening. This is bad news for other countries because products are suddenly more expensive than they were before, and people are losing their purchasing power as well. In past cycles, people believed that the dollar going up was the same as monetary tightening, but it could also be another disinflationary event for the U.S. This further increases the odds that we can see inflation slow pretty quickly. A strong dollar makes U.S. exports more expensive and imports cheaper. At the same time, it hurts corporate profit, which I have covered in another video. I will attach the link to that video, and if you enjoyed my video so far, be sure to like and share.
If you notice, the Fed is tightening into a slowing economy because global central banks have been tightening. The Fed is tightening while you have some very, very significant fiscal drag. Government spending is declining in this country while the Fed is raising rates. You have companies have too many inventories, and so very different than the 1960s and 70s. And we do think that inflation will also very quickly slow.
So you see, the Fed is still raising rates even though there are significant physical drags. Companies having too many inventories, people losing their purchasing power, government spending declining in the U.S., and Nancy believes that the inflation will quickly slow down.
Headline may stay more elevated. The April CPI was still up about 8.3% on a year-over-year basis. Month-over-month headline was actually pretty tame, only 0.2. The Fed strips out food and energy. They think that those are sometimes can be exogenous shocks, and that does appear to be what's going on with food and energy prices, both in part related to what's going on, unfortunately, in Russia and the Ukraine. It is core, though also similarly accelerated very sharply, reflecting the demand for all the goods. And in April, it was actually a bad number. Month on month, it was up 0.6. Year over year, it was at 6.2. What the Fed is looking at is what those readings do sequentially. And so that 0.6% definitely open the door for the Federal Reserve to do 50 basis points and to tighten again, probably another 50 as we go into the summer. That 0.6 month on month is a very, very high number. They are looking for that number to move down towards 0.2%.
There are also growing fears on Wall Street that the Fed may drag the economy into a recession as it seeks to tame inflation, which climbed by 8.5% in April and 8.3% in May, which is nearly a 40-year high. I understand that the most recent figures totally open up the door for the Fed to increase 50 basis points, and more tightening and similarly sized rate hikes can also be on the table. With Fed tightening the monetary policy, the global economic outlook turning bleaker, the U.S. economy might grow more susceptible to a downturn in the coming months. I believe that if the U.S. economy is to avert a recession, something will have to give. It may well be the Fed's inflation target. So that's it for today. If you don't want to miss my videos, be sure to subscribe and hit that bell icon. I'll see you in my next video.